2.75% reduction in the interest rate. You heard it first here from Ben Lerner.
Yes, by Wednesday.
I love it, Ben.
By this Wednesday.
I love it.
I think the National Association of Realtors has picked the number of 25 basis point reduction. So 1.25 is what they're...
Okay, we'll take that.
That's Ben Lerner from Certainty Home Lending with a more realistic look at the tea leaves than JT. He joins Team Sweasey on a lending conversation that you must listen to if you have been pushed to the sidelines with high interest rates in the past 2 years. Team Sweasey thanks you for listening and subscribing to the SLO County Real Estate Podcast, and it's now on YouTube, where you can also subscribe to watch the podcast at Hal Sweasey on YouTube. Just click the subscribe button with the bell next to it, and that'll let you know when the new video gets released. And it'll also let you know when there are market updates and other exciting information on the SLO County real estate market, including select listings. Here's your host of the podcast, James Bueno.
Everybody gets to see what we look like, so it's kind of scary.
There go the ratings.
Right, no, exactly. Hal?
Yeah.
How are you, sir?
I'm good. I'm a little nervous, though. I'm worried about what I can do now on camera.
I know, like, I'm not sure where to put my hands.
Mm-hmm.
That's the problem.
Okay.
JT, how are you?
I wish I had a good side so the camera could get my good side,
right.
but I don't have one.
There's actually a camera behind you, too. So
good.
So you've got a good color.
Yeah, we can see.
Brand new Rain Spooner Aloha shirt for this occasion.
Yeah, and we'll point it out here in a little bit. This a good-looking gentleman just walked in. We'll have to get him situated in a little bit.
Yep.
Hal, we have a guest today?
Yes. We've got a long-time mortgage broker. I've known Ben forever. I think we worked on your first house together in the 90s, right?
Correct, yeah.
That makes you quite old.
Yes, it does.
Okay. Well, it doesn't show. Can people see him on the camera?
Yeah.
Okay, never mind.
Everybody can see me.
So anyway.
And Jay as well.
So Ben, why don't you tell our listeners, where you work and your name and number and how they can reach you, and then we'll start picking on you about what's going on in the mortgage market.
Yeah, I just want to say I didn't know I was going to be on video. I've been told I have a good face for radio, but video never came into the picture. So it's good.
Yeah.
I work with Certainty Home Lending here in San Luis Obispo.
Yep.
And my team's been together essentially for the past 20 years.
Right.
And in this marketplace.
And if there's a phone number you want them to call you on?
Yeah, please, 805-441-9486. And call me even if it's not a deal and you just want to ask a question. Happy to speak to you.
The ever-changing mortgage market, John, this is your idea, I think, to talk about this. What should we talk to Ben about today?
Well, I think everybody in our listening and now viewing audience is interested in what's going on in the marketplace when it comes to interest rates. And I just think the last few times you've been on our podcast, we've had a great response to you being with us. I'm looking forward to hearing what you have to say about the current state of the lending business and maybe where you think we're going from here.
I'll take a broad stroke at that based on, I'm sure you've talked a little bit about rates over the last several episodes from what I've heard. Starting in the beginning of December, we had a market turn in interest rates from a high of touching near 8% on a loan down to we're in the mid to low sixes now on a 30-year fix. So quite a turn in a very short period of time. The big question really is where do we go from here? And I would say the market is still very much tilted towards improving rates. It's a little bit more sideways for the coming couple of months. The market is still pricing in, I think this morning the exact number is 68% likelihood of the Feds dropping rates in March, although that's decreasing. It was 80% a week ago. And it's starting to go down a little bit, which kind of means the data is kind of pointing towards it could be more of a second half of the year before we start to see the next real rally in interest rates and continue down the path of improvement. Not that long-term rates are directly tied to what the Feds are doing, but they're indirectly tied. So they're moving in lockstep.
What I'm hearing you say is over the last 6 weeks, rates have come down as much as 1.5 points almost.
At least 1.5 points.
What have you seen in terms of your application volume? Has that come up a little bit for you?
I would say the interest volume has gone up tremendously. Brings people out from the holiday doldrums, and we're starting to see much more market activity. Yeah. And I think the inventory is starting to reflect that too locally.
Ben, historically, and I don't remember, but it seems like rates move much quicker than they used to. Like home prices also move pretty rapidly. So, 1.5% down in 6 weeks, that's do you remember anything like quite that extreme?
No, I think, we're definitely in an extreme time. How quickly the Feds increased the interest rates over the last year and a half, where it was a pretty unique time. You have to look in history to see that sort of a growth and just a really dramatic change in the interest rate environment.
The increase.
The increases.
Yeah.
We went from basically 0% for the Fed funds rate to 5.25% in just a year's time. That's a pretty remarkable pace. So now I think you're seeing the results is they're taking the foot off the gas. We've been waiting to hear some less than aggressive tone from the Federal Reserve, and they're starting to give us a little bit of what we call that dovish tone from them. The market responded accordingly, saying, finally, we can take a breather and rates can find a normal level.
The difference on a mortgage between 8 and say 6.5, right? Because that's achievable today.
Yeah. I mean, at a $500,000 loan amount, every 1% is going to be a few $100s a month savings.
Yep.
And so you talk about going down 1.5, we've already improved about $500 a month for somebody doing that mortgage, which is a substantial change in their payment.
Mortgage rates are usually tied to the 10-year note, right? Treasuries.
10-year Treasury. Mm-hmm.
And then there's some difference always. And right now the difference, the spread, I guess they would call that, is a little bit larger than normal. And it's usually it kind of compresses and gets, and it's larger than normal.
I think what you're trying to say is
thank you. It's help. Yeah, you can tell I need help.
Yeah, I mean the 10-year Treasury is a good gauge for what long-term interest rates are doing. The 10-year and the 30-year bond. The reason the 10 and the 30 are the notes that we follow typically for long-term interest rates is that you're looking for where rates are going, not just where they are immediately. So
right.
when you talk about the Fed funds rate, that's an overnight rate. It's an immediate rate, which is used for credit cards and typically car loans and things that are pretty immediate on the interest rate. When you talk about a 30-year fixed rate loan, you're looking at, they don't want to set the rate based on where things are going to be today. They want to see what's the trend, where are we going to be going 10 years or 30 years from now? What's
right.
the trend building at? And so the revenue in those loans is based on how secure that path is.
Okay.
So right now in the mortgage lending market, not to get wonky, but margins over the last year and a half have been compressed. And it's because if you're a bank and you're lending out money on a 30-year fixed rate loan, but you're at 8%, and we know that the market's going to turn, they can see what's going to happen. The bank knows that that's not a long-term loan they're making. Even though it's a 30-year fixed, anybody doing that loan is short-term in that loan as the rates improve. And therefore, the bank doesn't have a lot of yield. They're not going to make a lot off of that loan.
Okay.
And so the margin is compressed on it.
Interesting. Okay.
Ben, meaning that they're likely going to refinance out when the rates come down because the rate they project the rates to come below 8. If that,
exactly.
In that example. Yeah.
Exactly. And then why would you, if the rates are, you locked at 8% or you did a loan at 8 and now we're at 6, even 6.5,
mm-hmm.
Why would you stay on that loan long?
Wouldn't, yeah. Absolutely makes sense. That's probably the difference. That's why the spread's 300 basis points as opposed to 200 basis points, which is where it normally lands.
Yeah, and I would have updated my specifics for this talk had I thought about it. But it's really interesting to look at mortgage companies over the last year and a half. It's not how much they're making; it's how much they're losing on each loan right now. So they're actually weighing. Very few companies made any money over the last year. It's how much they're losing per loan. That's actually a metric right now because of those margin compressions.
Wow. That sounds like an exciting business.
Ouch.
A year and a half ago when you were here, Ben, as rates were going up, you were making, I'll call it a concession. I don't know if that's the right word, with the people that were taking out loans with you, that you would do a refi for them, once the rates started to come down. Or is that still something that's in the environment?
I do free refinances for any of my clients. If it's, I set the line at 500,000, but it's a gray line. If somebody's at 450 and I'm going to help them out, I'm just going to take care of it. But yeah, we were also doing temporary buy downs last year when we spoke, and where we buy the rate down temporarily, 12 months, whatever, to help them. We're not doing that now, and as you can imagine, as the margins continue to get compressed, that got harder and harder to do. But absolutely, any banker right now that cares about their client base and taking care of the consumer should be offering up to take care of the refinances.
So the 3-2-1s, the 2-1s are something that are not out there in the marketplace today.
They're still being used. I still see them, but not from the lender side now. It's now just a seller incentive to a buyer.
Between the buyer and seller. I thought
Correct.
you meant Ben specifically participating, helping his clients out versus the buyer in this.
Well, I just meant the usage of that type of a loan. And what you're saying is it's still being used, but it's between the buyer and the seller, not with the lenders.
Correct. Yeah, I was using it just to stimulate the market and help out my realtor clients and make sure that they had a tool to get somebody off the fence as the rates went so high. And for me now, I don't use it, but I do see it being used still by realtors. And I think it's a great tool for that.
Yeah.
We've talked about it before, but remember the temporary buy down as opposed to a permanent buy down. the cost of that buy down is the borrower's, meaning if you do a temporary buy down and it's a 1 year buy down and the seller paid for it, if in 6 months I refinance them, the other 6 months worth of that buy down still goes to the consumer. It lowers their principal balance by that amount. So they still capture the full amount of the buy down.
So I heard on the news today that the average home buyer in America is 49 years old. The commentator was making a case that are young people losing the American dream of home ownership. How would you go about advising and helping a first-time home buyer that's substantially less than 49 years old?
And I read those stats too. I think National Association of Realtors and California Association of Realtors puts out some numbers on the demographics and where they see those demographics growing. We've consistently seen the average age of a first-time home buyer step up. You know, it's now in the mid-30s for first-time home buyers for a lot of them, and it used to be mid-20s. I think I met Hal buying my first house when I was 25 or 26.
Oh, I thought you were 11. Okay. So you were young.
Yes,
Yeah.
so were you. Besides, that demographic continues to rise where I've also read stuff about the baby boomers and how that's going to be an interesting generation as they age out of the property and glut of real estate, and that could change pricing. I don't believe that. I think the U.S. is 10 million short on houses right now, and over 1 million of those in California alone. I don't see a glut in housing anytime in the near term.
I also read this morning that our inventory is 15% below where it was a year ago.
Yeah, it's wild to see our numbers. I remember always looking in the MLS locally and for our county and seeing close to 1,000 homes when it was going really well. And I don't know where we are today, 300, 320, something like that in there. And
between 3 and 4, yeah.
Yeah, and it's crazy change.
So any other programs or things you're doing to help buyers in this rate environment? And I think you were mentioning before we started chatting or started the podcast, people kind of settle in, one, at certain rates and they're less likely to come down. And then two, of course, waiting to see what's going to happen with those rates. So what on the lending side, what are we seeing out there to help those buyers that are, on the edge or whatever to move them forward? Anything coming up or anything you're seeing?
Yeah, I mean, there isn't any great bond program right now like that have come and gone, the California Dream, and there's a new version of that's allegedly coming out shortly. But, really, from my side, I just push the refinance. I think it's a safe bet to talk about refinancing any clients that close now and just to give them that hope and run that scenario. I think it's a safe bet, whether it's 6 months from now or a year from now. It's expected to be a very market change. There was an interesting graphic that was sent around in my company. It had all the estimates from all the major banks and investment firms, so UBS, Wells Fargo, Chase, all the major banks and all their economists, on how many Fed cuts we're expecting in 2024. I think the low was, I forget which bank it was, one bank has 0, and the high was UBS is 275 basis points, or 2.75% this year. So that would be heavily, these are all December forecasts. So that would be heavily towards the end of the year. But as far as to hear them all whistling that same tune, I mean, and this is a list of the top 25 investment houses, to hear everybody whistling that same tune, it's a good song. Now, everybody has been wrong before, but that's a pretty good tune when everybody's pretty much on the same page.
Again, I read a couple articles this morning, and one of them shared with us that the number of transactions was down 23% in California in 2023. California Association of Realtors, by the way. The prediction was we were going to get back 22 of the 23% in the number of sales in 2024. You think they're looking at the same type of numbers that the bankers are looking at, that interest rates will go down and that'll drive the transactions?
Yeah, I think from my industry, we got two things going on. We have the purchase volume, which I think is picking up. And then we also are now going to have the refinance volume, which has been completely absent for the last year and a half. There's a twofold on my side of the table. And then I think what's been so interesting, and you and I spoke about it quickly, John, was, last year started, price appreciation was expected to be near nil as rates were climbing steadily. It looks like we're going to have 7% price appreciation from last year nationwide.
Yep.
So 7% nationally. Now we're pacing and we're expecting similar growth this year with a lot more inventory.
Yeah, Carr suggested just over 6% increase in pricing in 2024 in California.
So going back to these first-time people and how hard it is to buy, I still tell them, buy a house. It's still the best investment you can do.
Yeah, that was my next question. What are you telling people today? Like your kids are recent college graduates, and if you can, are you suggesting to them to buy as soon as they can?
For sure. It's just like, you can't time that. You want to get in as soon as you can and buy and hold, and the best investment that I can think of.
Yeah, it's a fool's errand to try to time the stock market.
It is.
I would say the same thing is true with the real estate market, wouldn't you?
Buy when you can, and you hold it and buy more.
You talk about being able to refinance and how your payment might improve. I think it's good for viewers to know too that it's not like you just get in and no matter what, because you're not getting that loan unless you can afford it anyway.
That's
the underwriters will not allow that to happen.
Pre-2008, before the meltdown, there was a little bit of common sense, or you could argue maybe it was a lack of common sense. If somebody had a ton of equity in a home, they had excellent credit, it was basically a given, and they would get their loan with little to no effort. And obviously that led to lots of problems because people abused that. They weren't honest in their applications. Mm-hmm. And it was definitely a catalyst for some of the meltdown. And now when you talk about doing a loan, even when I've got a loan right now and somebody's buying a $600,000 condominium, we're doing a $100,000 loan on it. They're retired people. They have plenty of money. They have plenty of income. I still have to go through all of the process for them. There's no more common sense to just say, gosh, we hope they default. The bank will get this back and make a mint off of reselling it. That doesn't happen. There is no mentality like that.
So retired couple.
Retired couple.
Probably never missed a payment on anything in their life.
Perfect credit.
Yeah.
Plenty of money in the bank.
So I think someday, won't there be a bank that would just look at that and go, in 5 minutes, go, yeah, they're going to suddenly change and stop making payments? I mean, I get what you're saying, the common sense. We're protecting against, the abuses we've seen at one point in our history and overcorrecting almost.
Maybe we should invent a new industry, the no BS loan.
Right. Yeah.
Well, they call it, so ATR stands for ability to repay. And it used to not be enforced across the board evenly. Now it's across the board evenly enforced on a loan. Mm-hmm. So that's why no matter what the situation is, retired couple, small loan, we still verify their income and assets the same way, whether it was at 100% financing or nothing less.
Where does regulation like that start? Where does it come from?
Congress. So.
Congress. There
the people
go.
who are experts in the ability to repay?
Yes.
Okay, good. Just checking. Just poking fun. Okay.
This podcast.
So
do we have to cut that out?
Is this Congress or is it the unelected government officials making these regulations?
Well, you could argue Dodd-Frank, whether they're elected or not, but Dodd-Frank, the Financial Reform Act, is from Congress. I mean, that was a response to 2008. To the meltdown, whether it's overly burdensome, or it's hard to call. I think the intent of the laws are good. I think the execution can be pretty poor sometimes.
Sure.
The pendulum swung so far in the opposite direction from stated income loans, which was the opposite side of the pendulum. Just sign it. We're good, right? But it did create a standard of care. I mean, everybody now has to go. That's a great example with the older retired couple. They're going through the same things as a first-time home buyer would. So it reduces and removes any type of financial or prejudice that might be seen towards any consumer. So it kind of levels a playing field and makes sure that everybody's treated fairly. I mean, if you're going to take a look at it from a positive standpoint, I'll lean into. I always look to the bright side.
I like your interpretation.
Yeah,
seriously,
my
that's
glasses
great.
are a little rosy, but that's okay.
Well, and people talk about if there's going to be another meltdown, and one of the things we could point to two things. We could say, one, we know how well vetted any borrower is presently, and then two, you could look at over the last 6-7 years now the foreclosure rate, which is near record low in our country.
Well, an equity position.
And equity.
Yeah, there was zero equity going in a lot of those, and a lot of people either starting with equity or they've built it. It's unlikely for sure.
2.75% reduction in the interest rate. You heard it first here from Ben Lerner.
Yes, by Wednesday.
I love it, Ben.
By this Wednesday.
I love it.
I think the National Association of Realtors has picked the number of 25 basis point reduction. So 1.25 is what they're...
Okay, we'll take that.
And so if that, what's that going to equate to in a mortgage rate, would you say? I mean, if they are correct, I'm not holding you to this. If they are correct.
Yeah, I'd say we're pretty safely finishing the year in the fives.
Okay.
for people out there that are on the fence, should I buy now or wait till it goes to 5? Your competition is going to quadruple if the rates are at 5%.
Yeah.
Buy now when they're in the low 6s, and then if you need to, refinance at the end of the year. Make sure your loan doesn't have a prepay, and if it does, you're past that when you do refinance, or work with someone like Ben that refinances for free.
Remember, a 1% decrease, we were told, equates to 500,000 additional buyers in the marketplace that only has 500,000 houses for sale. That means there's one additional buyer for each house on the market. What will that do to competition, Jay?
Price and demand economics, right? It's going to blow up. So to a point Ben made earlier, the rule of thumb here is to buy the real estate and wait. Don't wait to buy the real estate. Okay. Right? Wait for the rates to come down.
The best day to buy real estate was
20 years ago.
Yeah,
and today.
Best day. Yeah,
today.
There we go.
Yeah.
Why do I always feel like Jay's talking to me? It's like always directed
because
to me.
I am, James. Because it's
We're
today.
all talking to you.
I know. All right, gentlemen, thank you very much. We appreciate it. And Hal, let's let everybody know how to get a hold of you if they have any questions.
Sure. You can call the office anytime. It's 805-781-3750.
All right. Thank you, everybody, for watching, listening. We appreciate you.
And subscribing.
Everything. That's Jeff.
YouTube and on the podcast.
Yeah. We're
Wherever
growing
you
up.
get your podcast.
We're growing up. All right. Thank you, everybody. We'll see you next time.
All right. Thanks, James.
Good to see you, Ben.
Thank you, guys.
Thank you for listening to the Hal Sweasey podcast. Be sure to subscribe and rate this podcast. Check for it in your feed for the latest information on the San Luis Obispo County market. The Slow County Real Estate with Hal Sweasey podcast is available wherever you get your podcast and on halsweasey.com, where you can find current listings and other real estate tips. halsweasey.com, that's HALSWEASEY.com. I am James Bueno, Director of Marketing for the Hal Sweasey Group. If you're looking for anything real estate, give us a call, 805-781-3750.
Hal Sweasey is a licensed California real estate broker. DRE number 01111-911. The Slow County Real Estate with Hal Sweasey podcast is a production of AGM Podcasts. Subscribe wherever you get your podcasts.